Okay, let's unpack this. When most of us think about U.S. tax policy, we're usually just focused on, our own domestic income. But for anyone operating on a global scale, investors, big companies, even students, the real story, the real complexity is in its international rules. So today we are doing a deep dive into how the U.S. manages all that money crossing its borders.
And the source material we're using for this is, well, it's a fantastic roadmap. It cuts through some really technical stuff. We're going to take these key ideas, treaties, withholding tax, sanctions, and just define them simply. It's basically a shortcut to understanding big headlines about global finance and trade. You'll know the real rules of the road.
That's exactly it. That's our mission today, to understand how the U.S. government basically acts as the world's most powerful financial gatekeeper, a kind of door check, one that decides if moving your money is simple or, well, a complete nightmare.
And that check is so important just because of the sheer volume of money we're talking about. It's immense.
Let's ground this first, though. At its core, U.S. tax policy is just a set of rules, right?
Yeah.
Who pays tax, how much, and why. But once you add that word international, the why suddenly gets way more complicated.
It really does. Because now the U.S. government is asking three critical questions anytime money crosses that border.
Okay, so what are they?
They're really the three pillars of how it manages this whole system. First, there's safety. The government has to be sure that money isn't being used for, crime, terrorism, that sort of thing. It's a security issue.
Right, the national security angle. Makes sense. What's number two?
Number two is fairness. This is the classic reason for taxes, making sure everyone who is supposed to pay does pay, and that people aren't just, hiding money across borders to avoid their responsibility.
Okay, safety and fairness. And the third?
The third is the one where all these tools we're about to talk about really come into play, and that's relationships. U.S. policy is completely different depending on whether a country is a close partner or an adversary. That relationship dictates everything.
That's a great point. It's worth pausing on those three for a second. Safety, fairness, and relationships. Because they must conflict with each other sometimes, right?
All the time.
Like, the U.S. wants a strong trade relationship with a country, but maybe that country doesn't have a very transparent banking system. So the relationship goal clashes with the fairness goal.
That's a perfect example. International tax policy is a constant negotiation between those forces. But when there is trust, a strong relationship, the U.S. can relax a little on the safety and fairness checks. And that's what allows money to move easily.
Which brings us right to the ultimate symbol of that trust, tax treaties. Here's where it gets really interesting. What exactly is this agreement? How does it turn a good relationship into actual, dollars and cents?
A tax treaty is basically a formal contract between two countries, like, say, the U.S. and Japan. It's a binding agreement that sets the financial rules of the road between them. And they are incredibly detailed, covering everything from dividends to royalties.
And the main benefit everyone talks about is avoiding double taxation. But let's go a bit deeper on that, because being taxed twice, once where you earn the money and again where you live, that would just kill global investment, wouldn't it?
It would stop it cold. And treaties solve this with two key processes. First, the countries agree to share tax information. That helps the fairness part.
Okay.
And second, this is the really technical part, they establish very specific sourcing rules.
Sourcing rules. What does that mean?
It means they decide ahead of time which country gets the first right to tax a certain kind of income. Is it the country where the money was sourced or the country where the person receiving it lives? The treaty defines that, and it sets the maximum tax rate.
So it creates certainty. Investors and even workers or students know exactly what they're going to owe.
Precisely. It provides clarity, and that's invaluable.
And we're talking about huge economies here. Canada, the UK, Germany, France, Japan, Australia. These agreements are like the engine of global investment between allies.
They're a form of financial diplomacy, absolutely essential.
But if they're so great, why doesn't the U.S. just have one with every single country? Is it just politics?
That's the core tension. It's almost never just politics. For the U.S. to sign a treaty, the other country has to agree to a very high level of transparency. If that country's banking system is unstable or seen as a risk for money laundering, it clashes with that safety driver.
I see.
The U.S. will decide the benefits of the relationship just don't outweigh the risks. So no treaty.
And that is the perfect bridge to the other side of the coin. What happens when there is no good relationship? Or when the U.S. is hesitant? That financial perimeter check gets a lot tighter.
A lot tighter, exactly. If there's no treaty, the U.S. defaults to a system that is much more cautious. It prioritizes collecting tax immediately. And this brings us to its main enforcement tool, the withholding tax, WHT.
Okay, so define WHT for us in simple terms.
It's money the U.S. government takes before it gets sent to a foreign person or company. So if a U.S. company owes, say, a dividend to someone overseas, it has to first stop the payment, take out the government's cut, and then send the rest.
It's like the government taking its share first, just to be safe.
An immediate financial safety net for the IRS.
Yes. And this is where the stakes get really, really high for investors. Because the standard WHT rate, if there's no treaty, is a flat 30%.
A massive number. It's almost a third of your income gone instantly.
Wow.
And that 30% rate is a big stick. It's punitive on purpose. You compare that to a treaty country where the rate on that same dividend might be 15%. Or for interest, it might be 10%, or even 0.
So that difference is the entire game. It completely changes whether an investment is even worth making.
It really does. If I'm a German company, I get a huge benefit from the treaty. But if I'm, say, a Brazilian company getting the exact same payment, I lose 30%. Just like that.
Simply because the governments don't have that piece of paper signed.
Exactly. And that high tax rate, of course, it makes people look for ways around it, which is why the U.S. developed other tools to make sure that fairness driver wasn't ignored.
And that leads us to FATCA, the Foreign Account Tax Compliance Act. It sounds like a boring tax law, but it's really not.
Not at all. It's basically a global financial surveillance law.
Oh.
It was created to stop U.S. taxpayers from hiding money in offshore accounts. So it forces foreign banks outside the U.S. to report account details for any U.S. citizen who banks with them.
And how does it force them? I mean, they're foreign banks.
It forces them with a huge financial threat. If a foreign bank refuses to cooperate with the IRS, the U.S. can impose a 30% withholding tax on any U.S. payments going to that bank.
So it would cripple their business.
It's devastating for a global bank. The ultimatum is cooperate with our tax laws or we'll punish you severely.
It's a huge enforcement tool. And I know it's controversial. It promotes fairness, sure, but it also forces foreign banks to do the IRS's job for them.
It's a perfect example of the U.S. using its financial muscle to enforce its rules globally. So we have withholding tax for caution, FG for fairness. The final and most severe tool is when the safety driver completely takes over, and that's sanctions.
We hear that word sanctions all the time in the news. How does it connect to tax policy?
Sanctions are the nuclear option. They are broad restrictions that just stop financial transactions entirely. They're run by the Treasury Department, and they target regimes or people who are considered a threat to U.S. national security.
So when a country is under heavy sanctions, we're way beyond worrying about a 30% tax rate.
Oh, way beyond. Under sanctions, tax policy becomes about prohibition. Money movement might just stop completely, or you might need, extraordinary government permission to do even a basic transfer. The goal is total financial isolation. The sources point to places like Iran, North Korea, Syria, and more recently, certain sectors in Russia as examples where this is happening.
Okay, so let's tie this all together. Treaties, WHT, FATCA, sanctions. Let's make this real for you, the listener. We can go back to our two stories and see how this actually plays out.
Yeah, let's see what 20 percentage points really looks like.
Okay, story one. Leo. He lives in Brazil, which doesn't have a comprehensive tax treaty with the U.S. He invests $100,000 in a U.S. company that pays a 4% dividend. So he earns $4,000 a year.
But there's no treaty. So the U.S. immediately takes the full default 30% WHT.
That's $1,200. Gone. Just like that.
Yep. He gets $2,800. And then he's stuck with a bunch of paperwork in Brazil trying to get credit for that tax he already paid, which is never easy or guaranteed.
Now, story two.
Yeah.
She lives in Japan, which has a great tax treaty with the U.S. She makes the exact same investment. $100,000, same dividend.
But her treaty reduces the WHT on dividends down to, let's say, 10%.
So she earns the same $4,000.
But the U.S. only withholds $400. She keeps $3,600.
That's an $800 difference every single year.
Purely because of a diplomatic agreement between their two countries. It's an incredible difference, and her paperwork is much simpler, too.
That makes it so clear why countries fight for these treaties. They're literally worth millions, even billions, to their citizens and businesses over time.
And that's why this matters for you. Understanding this perimeter, it gives you the vocabulary for real business conversations. It also gives you practical knowledge. I mean, if you're thinking about working or studying in the U.S., your country's treaty status is going to determine how much of that paycheck or scholarship you actually get to keep.
And it helps you read the news with a sharper eye. When you hear about sanctions on a country, you'll know it's not just a political statement. It's an immediate, severe financial chokehold that changes everything for businesses in that country.
The U.S. is the gatekeeper, and the rules are all set by those three drivers we talked about: safety, fairness, and relationships. A treaty means cooperation, so you get lower, easier taxes, no treaty or sanctions. That means stricter rules, more paperwork, and that painful 30% tax.
So what does this all mean for you now that we've gone through the mechanics of it all? We've seen that one international agreement can be worth 20% of your income.
So now that you really get the stakes, the huge difference between that 30% default rate and a nice negotiated 10% rate, think about your own country, does it have a comprehensive tax treaty with the U.S.? And if it doesn't, what does that friction really mean for your own future plans, whether it's for business or study or investment? That's the kind of knowledge that changes how you see the global economy.